Well, good morning, everyone. My name is Evan Troop. I'm a managing director at JP Morgan, and my team, we manage about $9.5 billion. So that's in partnership with institutions like Milestone, as well as working with individuals. But what I wanted to do today was, given the recent bout of market volatility that we've seen really since August, I wanted to kind of walk through what we're seeing in the market, but then also paint a little bit more of a rosier picture as we move into Q1 of next year, because we've been in a going on 2-year bear market cycle. However, based on what my model is showing me, we're most likely going to be coming out of this sometime in Q1 or Q2 of next year. With that being said, let's dive into it. So these are my second half 2023 themes that I released back in April. And as you can see, pretty much all of this has come to fruition here. So the first projection that I had was that risk assets would struggle, most likely starting in August through January of 2024. And we've seen this. All of a sudden, the dollar is rallying, long rates are on the rise, and that is causing risk assets to fall. The second theme was that reflation, as opposed to disinflation, was going to be the dominant regime. And what we saw is CPI really troughed back in June. So, it traded from 9.5% all the way down to 3%. But then all of a sudden we saw oil starting to rise, corn, wheat, soybeans, other commodities that ultimately led us to believe that inflation was not something in the rearview mirror and would ultimately persist most likely through Q1 of 2024. The third bucket was that geopolitical conflict would escalate. Certainly did not call for the war breaking out in Israel. We were more looking to China and Taiwan. In addition, NATO potentially getting involved in the conflict in Ukraine. However, here we are, and Hamas has attacked Israel, and all of a sudden it looks like the Middle East is really going to break out into a much more broad conflict that we'll have to keep our eyes on. The fourth bucket there was that longer rates were going to be higher for longer. So back in April, when I made these projections, the 10-year Treasury was trading my model 370. Today, we find ourselves all the way up to 5%. And what the model is showing is that the 10-year could potentially continue on here on its upward trajectory, most likely to 5.25 to even as high as 5.5 by year end. The fifth bucket was that given we were going to be in a reflationary environment, most likely we were going to see 2 more rate hikes from the Fed. I don't believe we'll see a hike here in November. That's due to the fact that long rates have risen so much and thus tightened financial conditions. However, my model is still pointing to about a 90% probability that we'll see 1 more rate hike in December, which would bring the Fed funds rate to somewhere between 5.5 to 5.75. And then finally, while I didn't see a recession coming in the US in 2023, what the model was showing was that Europe was going to enter in recession starting in Q4, led by Germany. I've got a couple of charts towards the end of this presentation that'll show that's exactly what is starting to take place here. So switching over to the equity markets, you can see earlier this year we just had a absolutely blinding rally to the upside. The S&P 500 from January all the way up through August 1st was up almost 20% on the back of what was termed an AI revolution. I would call it more AI hype than anything else, because this technology has been around for quite some time. In fact, the proprietary model that I use implements AI technology. I started building that out in the 2018-2019 timeframe. But regardless, here we are. So all of a sudden we've peaked. We're now in this very defined down channel. I made this chart a few days ago. All of a sudden, we're very quickly down to this 4,200 level on the S&P 500. And what my model is telling me is most likely by the end of the year, we'll fall somewhere between 3,800 to 4,000. Certainly don't expect the market to crash. I think the economy is still running much too hot for that to happen. But again, a healthy retracement back down to that key support level, in my view, is the most probable outcome. And what led us up is again, big tech. So the Magnificent Seven, the Apples, the Nvidias, the Amazons, you can see just an absolute blistering rally to the upside. And now these names are starting to fall back to earth. And specifically for Apple, I wouldn't be surprised if at the end of the year, we end up trading somewhere between 145 to 155. Again, kind of back down to that key level of support. And the hype that we saw, it wasn't only in the tech space. I wanted to include this chart because this was just a miraculous move in my view. If you look at the bottom part of the screen here, the 30-year mortgage rate was oscillating somewhere between 6 and 7.5% over the last 12 months. Despite rates being elevated, you saw almost an 80% move to the upside for the S&P 500 home builders. And now all of a sudden, since August, you're really starting to see the hopium come back out of the market as the realization comes in that quantitative easing is not on the horizon and the Fed will not be cutting rates anytime soon. And so this is a chart of the 30-year Treasury bonds. As we sit today here on October 23rd, the bond is trading right at about 5.05%. And what I wanted to show with this chart is most likely by the end of the year, we're probably going to be trading down in this 101 level in terms of the price action of the bond. So a 101 on the 30-year Treasury takes us down to about 5.5%. So again, as long rates continue to climb, this is going to put downward pressure on equity multiples. And again, it's going to be very challenging for equities to hold the current level that they have in that 4,200 range on the S&P 500. And a big driver as to why long rates are rising is that foreign governments are selling U.S. debt. So if we look here, this is a chart of U.S. Treasury holdings in China. You can see just a mere 12 months ago, they were holding $1.1 trillion worth of our $33 trillion in debt. All of a sudden, they've sold to the tune of about $400 billion down to 835 billion. This data is actually stale by about 2 or 3 weeks. It's actually below 800 billion now. So we're seeing this theme really across a plethora of foreign governments. It's not just China. There's about 40 other countries that are currently selling our debt in the open market as they realize that the fiscal path that the government is currently on is just completely unsustainable. And so they're really starting to doubt whether or not the US can ever pay back its debt. And given the fact that long rates are rising, all of a sudden we find that the yield curve is uninverting. So this is a chart of the 10-year Treasury minus the 2-year Treasury. You can see dating back here to July, we were negative to the tune of about 110 basis points or 1.1%. And all of a sudden, as longer rates are starting to rise, we find ourselves with a yield curve that is almost back to flat. And the reason that I wanted to highlight this is normally the last leg down of the bear market occurs when the yield curve is uninverting. And so again, we've been on this 2-year downward trajectory really since November of 2021. Most likely by the end of Q4 into Q1, we're going to trough, and then the next bull market cycle will start, albeit, and I'll go into this a little bit later, it's going to look quite different than what we've seen over the last 10, 11 years. Another reason for risk assets going risk off here is because the US dollar continues to strengthen. And this intuitively makes sense. So the conflict in Europe continues to rage with the war in Ukraine. What we see, and I see it all the time here on the trading desk, is that large institutional European investors are selling euros to get long US dollars. And that is just simply a flight to quality trade. Now, all of a sudden, with the war breaking out in the Middle East, we're seeing the same thing over there. The Israeli shekel is down 30%, the Iraqi dinar, on and on. And this is really causing the dollar to continue to rise. And as the dollar continues to strengthen, we would expect foreign profit taking, because people that are holding domestic US equities abroad, ultimately, if you're getting killed, so to speak, on the foreign exchange risk, you're going to be looking to sell that exposure. And so this is just another reason why we expect in the coming months for the US equity market to continue to be risk off. And it's not even in the Middle East or Europe. Here is a chart showing the US dollar versus Japanese yen. You can see here just an absolute parabolic move for the vast majority of this year. And the reason why I wanted to show this chart is normally this is a contrarian indicator for the S&P 500. So the S&P 500 is this gray line demarked here. you can see that as the red line, which is US dollar versus Japanese yen, strengthens, that normally shows a risk-off environment within the S&P 500. So you can see here the S&P 500 has started to roll over. We still haven't seen a full capitulation event. And again, I'm not calling for a market crash, but I really believe that into November, first part of December, it's going to be quite volatile out there. And then finally, as I touched upon earlier, Europe is very quickly headed into recession. So apologies here as the bottom part of this chart got cut off. But from the high back in August, the German DAX index, which is their equivalent of their S&P 500, is off to the tune of about 8.5%. And what my model is showing is that most likely there's another 10% or so drawdown that will continue to occur in Europe here throughout the end of the year. So volatility has picked up, as we've been talking about here. We've talked about the reasons behind that. I'd now like to pivot and kind of talk about why now is a great time to set up a fee deferral, or within your taxable side of your portfolio, be looking to potentially add risk. So the first point I'd like to make there is that even a conservative bond portfolio is now yielding 6%. So that's really taking on a very low amount of risk. We're talking a 1 to 5 year bond ladder, investment grade bond ladder is generating that 6% type handle return. And if we think about the rule of 72, take 72 divided by your expected return rate, that is how long it'll take for your money to ultimately double. And so at a 6 handle with yield, that means your bond portfolio will be doubling every 12 years. And the second thing as to why I believe now is the time to put a fee deferral in place with a good partner like Milestone is because ultimately I see a scene change for the equity market taking place sometime in Q1. Now, when this happens, we will most likely be heading into a new bull market that lasts through 2029. However, this new bull market will be much more commodity and industrials driven. I really show geopolitical conflict crescendoing all the way through 2027, 2028. That'll help the military industrial complex continue to catch a bid. And then furthermore, I really expect commodities to continue to rise. So all that being said, if you have a very prudent portfolio manager that can tactically trade what's going to be a higher volatility regime here moving forward, I mean, even a 60% fixed income, 40% equity portfolio, you should expect annualized returns of 8 to 10% over the next 5 to 10 years. I think that's going to be very achievable, just given the fact that rates have risen so much. And so I'll stop there. I wanted to keep this brief here, 10, 15 minutes in length. Again, my name is Evan Troop. Please feel free to reach out to me if you have any questions on what I've touched upon here. If you'd like to get a fee deferral in place and talk about that, please reach out to your Milestone representative. We're happy to hop on a call any single time and kind of walk through a solution that's going to fit your needs and the needs of your family. So again, thank you for your time, and we'll talk to you soon.